Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 236 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvily, bring you everything you need to know from the past week in the world of financial markets and financial planning. This week, Matt is out on a business trip, so Nick Whitaker is joining us again. So thanks for stepping in again, Nick.
Always good to be here.
As always, we will quickly review the month-to-date and year-to-date, obviously the same in January, performance numbers of the major market indices that we track, and this data is from Y-Charts as of the market close on January 24th. S&P 500 index up 2.1% to start the year. Dow Jones Industrial Average up 0.3%. The NASDAQ Composite Index up 3.1%. The Russell 2000 Small Cap Index down 3.2%. The Vanguard All World Ex United States ETF down 1.8%. 3-month Treasury rate sitting at 5.44%, 2-year Treasury rate at 4.34%, and the 10-year Treasury rate at 4.18%. Big headlines, current events from this week, Nick. Stocks had a pretty solid day for the most part yesterday after gains in tech stocks after some earnings reports. Shares of Netflix rose as much at one point as 11% in pre-market trading after the firm said yesterday it signed up 13.1 million customers in the final 3 months of 2023. So this was the streaming giant's best quarter of growth since viewers were stuck at home in the early days of the pandemic. So Netflix getting back to its growthy ways. But then Tesla also reported last night, and it looked like, Nick, that report was taken negatively by the market. I don't know what Tesla is doing right now, but I can probably tell people what it is doing pre-market, and it's getting creamed, down 8.5%. So
yeah, you're going to see a bit of a yo-yo effect in the markets today would be my expectation. Tech really got a bid yesterday from Netflix earnings, and you're going to see kind of that undone. You're going to see a reversion trade today in the tech market especially, and there's a lot more coming in the pipeline with earnings. So just be aware of that, listeners. You're going to see a lot of headlines. You're going to see a little bit of volatility, especially kind of in the tech sector and little pockets of the tech sector over the next probably week and a half.
Yeah, I would agree. Yeah, we got some big earnings reports coming over the next 2 weeks. So volatility might be a little elevated until those are over. Last thing, Wednesday morning, the People's Bank of China, their governor said that the nation will cut the reserve requirement ratio for banks in early February by 0.5 percentage points. This is a move to kind of stimulate the economy, get more money flowing around, because China hasn't been in a great spot here recently, and that's shown in their stock market. So trying to stimulate growth over in China.
I saw an interesting, on that note, I saw an interesting stat this week that India's stock market officially surpassed China's stock market as far as market cap on the exchanges. So I'm sure they didn't love that over in China. So we'll see.
That's been a little bit of to turn that around.
Yeah, China's been weighing a little bit on global stocks, ex-US. When you think of those numbers that we quoted at the beginning of the podcast, the Vanguard FTSE All World's down 1.8 relative to the US markets, up, call it 2%. China's been weighing on that a little bit.
Right. Moving on to tweets, articles, and research from this week. First thing I had was a tweet from Seth Golden on January 11th. And Jenna will throw this up on the YouTube page. He says, rate cycle and recession. The average duration from the first rate hike to a recession is 27 months. The average duration from the last rate hike to a recession is 9 months. The average duration from the first rate cut to a recession is 3 months. And he says the consensus data estimates a recession in Q2 of 2024. So if you think about it, Nick, the market is pricing in, at least as of earlier this week, 4 rate cuts at some point throughout the year. And the big thing that sticks out to me in this data set is the average duration from the first rate cut to the next recession is only 3 months away. So if we see a rate cut and possibly we see a yield curve inversion, that could mean that a recession is coming sooner rather than later. But until those things happen, I don't really think we need to be worrying about this too much right now. Just my personal opinion, but I just thought it was interesting that Seth put this data out because everyone is waiting for that recession shoe to drop, so to speak. Everyone expected it was going to be last year. It didn't happen. And people are still waiting for that to happen. So I think, after you get your first rate cut, that's a sign that it's coming. And then when longer dated U.S. Treasury bonds are yielding more than shorter dated U.S. Treasury bonds, that's another sign that it's coming. And those things haven't happened yet. So definitely things we're going to be paying attention to, but not as of much concern right now.
Yeah, it's something that the market is, strategists have been kicking the can on this and moving things around. It's very difficult to predict. This is a strange environment we're in. So I actually have a piece on this a little bit later that's kind of entwining. So I'll leave it there.
Yeah, I agree. Second thing I had, Nick, I think you'll get a kick out of this one. This was a tweet from Franklin Templeton on January 10th, which will also be up on the video for people to see. They tweeted hashtag new profile pic, and it is the Franklin Templeton logo with laser eyes, which is kind of concerning. So if people don't know anything about this, a lot of people that are Bitcoin bulls or Bitcoin enthusiasts, a year or two ago, I think it was, Nick, they all changed their Twitter profile or X profile pictures to have these laser eyes, on Twitter. And I guess that meant that, if they were super bullish Bitcoin or whatever. And now you have a major financial institution doing the same thing. And this was in response to the Bitcoin ETF, spot Bitcoin ETFs being approved for the first time. I think it was last week or 2 weeks ago. And since the approval of those ETFs, I think Bitcoin's down like 20% or something. So a nice little contrarian indicator, at least in the short term, from Franklin Templeton. But, this is something that retail traders are going to be paying attention to because it's much easier now to buy or have exposure to Bitcoin in your retail trading accounts. Instead of setting up, an account at Coinbase or another crypto trading firm, it's going to be a lot easier to do at major U.S. financial institutions. So I thought this was interesting. When they posted this, I was like, oof, this over the next couple of weeks at least, Bitcoin, if I had to guess, if I was a betting man, wouldn't do too well, because typically when people get this excited about things, it doesn't turn out too well.
Yeah, or it's gonna ride a hot streak for a little bit and then absolutely plunge. You see that a lot when things are unnecessarily in the headlines. But Franklin Templeton they're huge. They're $1.5 trillion. And it's broken up. They have a ton of notable subsidiaries. Putnam Investments, Franklin Advisors is a really big one. Some of like the big. This is an example of one of the big institutional money managers that I know listeners have heard us refer to. They have a number of major institutional money managers kind of under that umbrella of Franklin Templeton. So It is
Yeah,
interesting to see this kind of like hot take.
yeah, it's
Tweet.
just one of those things where, it's again, people on the outset might not think it makes a whole lot of sense because last year, like no one was talking about crypto and Bitcoin, right? And it was up over like 100%. And then just to start this year, you have a crypto ETF, several crypto ETFs, I think like 11 or 12 that have been approved. So that means more access to cryptocurrencies for the everyday person. And most people would be like, "Oh, that should be a good thing for Bitcoin." And yet, since that has been announced, it's down 20%. So, not always things aren't always as they seem in the markets, which we know all too well.
Indeed.
Last thing I had, Nick, was a tweet from Charlie Bilello on January 22nd. Jenna will throw this up. Charlie says the S&P 500 closed at an all-time high last Friday, while the Russell 2000 small cap index was still in a 20.4% drawdown. That's the largest Russell 2000 drawdown we've ever seen, with the S&P 500 at an all-time high. What happened the previous largest Russell 2000 drawdowns when the S&P 500 was at a record high? Both indices would rally higher over the next year, with the Russell 2000 outperforming and joining the S&P 500 at an all-time high. This happened in April of 1999. It happened in February of 1991 and January of 1985. And over the next year, the Russell gained, 36.5%, 35.5%, and 18.2% when we've been in similar circumstances. So it is a little bit of abnormal for a major market index to be so far off an all-time high when the S&P 500 is making an all-time high. But it doesn't seem like it's all bad news because this has happened before, and the Russell tends to catch up at some point. And I think as you see breadth get better, meaning more stocks participating to the upside, hopefully this year rather than last year, that the Russell will catch up rather quickly.
Yeah, I think in part, some of this price action has to do with what the market is trying to tease out and predict with when will the recession come and when will the rate cycle turn, particularly the recession piece, right? It's almost like the market's really waiting for a catalyst to start bidding up the small caps, as opposed to getting into that trade really early. I'm sure there's major institutions that are already very long on small caps, for example, but yeah, I think it could just take a catalyst before we kind of see that catch up.
Yeah. And it's kind of interesting because typically all caps lead coming out of a recession, right? It's a risk on
Yep.
trade. So maybe in this recession, it just looks more like, hey, the Russell 2000 small cap index holds up a little better than, the S&P 500 or the NASDAQ or the Dow, which would be not normal from what
Right.
we've seen in a recession. But maybe that's already kind of priced into the small cap weakness we've seen over the past couple of years. So definitely something we will be watching, but I'll turn it over to you.
Yeah, this works well. Kind of going into my piece here. This is actually all of my research pieces I picked up from different kind of Bloomberg sources. This is from Bloomberg Odd Lots newsletter. It's kind of an opinion-based newsletter from Tracy Alloway and Joe Weisenthal. I like Joe's stuff a lot. He's a good writer. Has some good takes. So this is a piece kind of within the newsletter. It's kind of a long thing that I grabbed. It's interesting to think about this in context of the recession and the rate cycle, and there are many different opinions and what will happen. And we've been talking about this for, it seems like, I don't know, months and months and months, maybe even a year, where it's like, okay, the economy is strong, but we keep talking about a recession. What's going on here? When are we gonna kind of get there? And but the market is already gone through that trough in 2022 and kind of came back in 2023. So kind of like what's going on? Remember back during like the technical recession when we had those 2 quarters of GDP? Was that the recession? Have we already had it? There's been all kinds of debate about that. So um, Joe says the following in this newsletter: the stock market is not the economy. You hear this line over and over again, and I guess it's true, but as I've argued before in this newsletter and elsewhere, it's not the economy. A little bit of humor there for listeners. In other words, when thinking about whatever you want to call the economy, you can't just ignore the stock market as if it has no bearing on anything. And so to start, it's worth noting that the S&P is near all-time highs right now. Um, high stock prices matter in all kinds of ways. For one, there's the wealth effect. People look at their portfolio retirements, they feel more secure, more inclined to spend. When stock prices are high, managers don't feel as much pressure to cut costs and show investors that they're taking some sort of swift, bold action. Remember, a year ago, we're seeing all the tech layoffs. Many of these companies, like Meta, have seen stunning turnarounds in their share price over the last year. Jenna will throw up a couple of charts here, but this Meta chart will kind of show that dramatic turnaround. And we've seen this. This chart's very normal across a lot of major players, kind of seeing that big, I would call it a little bit more of an elongated V relative kind of to like the COVID that we saw. Um, Continuing with what Joe says, it's unlikely that the company, Meta, will be doing any big wave of layoffs at the levels that we're seeing. High stock prices also represent a currency for corporate acquisitions, so they will allow for more robust deal activity. What he means by there is merger and acquisitions. For those that don't know, high stock prices also mean a wider IPO window. IPO is initial public offering. Whenever smaller companies go public to gain more access to the debt markets. This means more opportunity for private companies to get a liquidity event. There's also still ambiguity over the state of the economy, obviously. The recent jobs report had some hints of weakness, although initial jobs claims have been solid. But it would be weird, given the top chart, S&P 500 being so strong, if it turned out that we're on the doorstep of a recession. And that's kind of how he ends it there. It would be weird, given where we are, if it turns out we're on the doorstep of a recession. And I think this is what the market's really trying to figure out. And we're talking about the rate cut in March, and the market really wanting that and expecting that. And you've seen Fed officials come out over the past few weeks and really try to throw some cold water on that. And it's just because we're not there. The economy's still strong, and inflation's, there's still some work to be done. So, a lot of talk about this, but there's just a bit of a kind of devil's advocate take for you guys, while also, talking a little bit about the stock market. So I liked that piece.
Yeah, I agree. It'd be very weird because Matt and I were talking yesterday. The most bullish thing a stock or a market can do is be making an all-time high, and there's a lot of people out there that a recession is not that far away. So that would be weird. And number two, to make it even weirder, if the Fed cuts rates in March while we're hovering around all-time highs, that would make the situation even weirder, right?
Yeah,
That's a stimulative measure that they take, and and the market would be close to an all-time high.
yeah, and it seems like the powers that be, the big powerful players in the market, it almost seems like they always want an easier monetary policy, right?
Yeah.
Always. They want free money. They can make more money when money's cheaper, right? Um, and I was kind of shocked over the past quarter when they're forecasting rate cuts in March. I'm like, there's no way, there's
Yeah.
just no way. The ECB still hasn't cut yet, right? So, um, it's just interesting to see. So we'll kind of see how it plays out. Do you have anything else to add before we kind of move on?
No. No.
The next piece I have, I lied earlier when I said all my pieces were from Bloomberg. This is actually from FactSet. So sorry about that. I'm calling myself out. It's just checking in on earnings thus far. It's a tweet from FactSet. The SPX, S&P 500, is reporting its lowest net profit margin since Q2 of 2020. I have a little disclaimer here for listeners that when we show this chart, please keep in mind that this chart could change. There are still very major companies that have yet to report, like at least like half of the top 10 companies in the market have
Yeah.
reported.
Yeah.
Apple, Amazon, Microsoft, Google, to name a few. So this chart is subject to change. But it does show, we are, moving along in the earnings cycle here. So it is interesting to see that the profit margins are down. This is the kind of activity that you would expect to see kind of leading into a recession, more so, kind of leading into rate cuts. I do expect this chart to come up a little bit. Full disclosure, that's an opinion of mine. But we'll see. It's something that investors keep a very close eye on, is profit margins, and the C-suite as well, of course. So we'll see what happens here.
Yeah, and I don't, people have been calling for peak profit margins for a long time, and Matt's been on this soapbox talking about that for a while, but it's not necessarily a timing mechanism, in my opinion, profit margins. So even if it,
Yeah, I
it
agree.
dips for a quarter, it could come right back the next quarter. So, and remember too, we've been coming off of a very high inflationary environment, so you would expect profit margins to be less than average right now.
Yep. Exactly. My last piece is just kind of an interesting thing I saw this week on union memberships at a decade low. There's been a lot in the news on the union deals over the past year, but I've not seen a chart like this. So I just thought it was kind of interesting, and just to kind of educate listeners. This is from Bloomberg and the Bureau of Labor Statistics. So it says the following: U.S. union membership hit a record low in 2023, even as labor capitalized on high-profile talks with automakers and actors and won the biggest raises in years. Lenders like United Auto Workers President Sean Fain remained hopeful and set audacious goals for 2024 and beyond, looking to organize companies like Tesla. So there's been a lot in the news about the UAW, and winning, having some big wins. But sometimes it's nice to check in on the big picture on unions, and this chart does just that, which I love a big picture historical chart. This one goes back to the 80s. Says U.S. membership ticks down to fresh record lows. This is the percentage of U.S. workers that are members of unions, which you could see pretty clearly has declined substantially over decades, from 20% back in the 80s all the way down to about 10% present. So just kind of nice to remind listeners of the big picture, and you can go chasing a union job, but there are always risks associated with such positions.
Right.
Fortunately, or unfortunately, however you want to, it probably just depends on the shoes that you're standing in there. But this is the big picture of unions, and we saw this, back in the 80s, whenever things started to change, and a lot of it just got down to, companies and capitalism and searching for better ways to increase profit margins. Right. That's probably what triggered a lot of the changes in this space.
Yeah, and I think the other thing is that I usually say on this podcast that either things make sense to me or they don't make sense to me, and this is a chart that makes sense to me because if you think about it, unions were put in place to protect workers, right? Physically, number one, and then protect workers' rights and all that. And obviously, with the acceleration and innovation of technology these days, there's not much as need for the physical protection, right? So it's no surprise to me that union membership is trending down towards a record low.
Yeah.
Well, moving on to the financial planning topic of the week. Pretty simple one, I guess, Nick, compared to some other ones that we've done. But this was from a blog post from Thomas Koppelman on December 19th titled Options for How to Manage Your Finances as a Married Couple. And I don't think it's a secret that there's really only three options here. It's either, keeping your finances completely separate, keeping them 100% combined, or a hybrid of both. So he had a blog post on this, just wanted to read a few points from it. So obviously the first option, finances are completely combined. So this means that no matter if both spouses work or only one does, that all income goes into one shared joint checking account, and all your bills, savings, and investing, come from this account. So pretty easy there. Number two is the complete opposite, keeping finances completely separate. You each have your own bank accounts. You each pay your own bills. Or if the income, if one spouse number one's bringing in 70% of the income and spouse number two's bringing in 30% of the income, then bills and mortgages are split that way as well. But the interesting one, to me at least, Nick, was number three, the hybrid method. So he says this method is the one that I'm seeing more and more often with newly married couples. It begins with opening a joint checking account and perhaps a joint credit card. Both spouses still maintain separate checking and savings accounts. Each spouse contributes a certain allocation of their income to that joint account to pay shared bills. You'll use the joint credit card for joint expenses and then pay off the balance using the joint checking account. The hybrid method allows for a bit of a time buffer between truly combined finances and entirely separate. Over time, most married couples share their assets. The great part about this hybrid method is that after you've allocated to the shared account, you still maintain some degree of financial freedom to spend your remaining surplus on things you might want, but your shared needs are being met. Joint savings accounts are great for saving for shared goals as well. There are a ton of financial decisions you will be faced with as a couple going forward. As you begin this journey together, you'll need to find a strategy that works for you. Give each of these methods some consideration and determine what's going to work best. Communication is your first priority. Make sure you're on the same page and be open about your goals. It will save you time, money, and emotional stress in the long run. And that was a thing I think, Nick, that I wanted to get the point across to people is you just have to do what works for you, and you have to be communicating about it and be transparent about it, because something that works for me and my wife, for example, might not work for Matt and Rachel, or might not work for you and Haley, right?
Mm-hmm.
So it depends on the type of person that you are, and you just need to get on the same page about it, because I'll tell you what, man, we've seen it firsthand. Money does some funny things to people, right? And if you're not communicating about it and you're not having an open and honest discussion about it, you're going to run into problems. So it's better to take care of that and have a conversation about it and get on the same page than just kind of push or kick the can down the road, so to speak, until you actually have a problem.
Yep. Yeah, absolutely. I think I think probably everyone out there has gone through, I mean, maybe not everyone. I would say everyone who's been in a long-term relationship, maybe let's call it above mid-20s, has maybe even run into issues with this. This is part of life, right? It happens to all of us.
Yeah.
But I'm a big fan of, and we've talked about this a couple months ago, maybe towards the end of last year, about kind of refreshing your budget and looking at your financial, personal finances, kind of year end or every year at whatever time works best for you. This comes into play, and just putting it all on maybe you're a pen and paper person, that's fine. Personally, I'm an Excel guy. So, having it all in Excel and, sitting down with your partner and kind of looking at it and just breaking it down, maybe one person's a little bit more, you know, strong in the budgeting area and whatnot. And just being able to see it really helps a lot. And the big thing for us, I know for you as well, is okay, let's make sure the retirement savings and all of that, and let's make
Precisely.
sure we're contributing properly to the 401k, and okay,
Mhm.
hey, I think we need to bump that up a little bit. I
Yeah.
think it's time. Things like that. So
Yeah, and in addition to that, like making sure, retirement accounts are taken care of, but then, sitting down and having a planning meeting about, hey, what are our priorities this year? Like, do we want to go to Italy, or do we want to go to Hawaii, or
hmm
is there a family member that's having a 50th birthday or a 60th birthday, and
yeah,
there's going to be a family trip, but we also want to renovate the basement? It's like, okay, well, we can't do all of these things, right? So
yeah,
we need to prioritize what
yeah,
things are most important to us this year. And there's not a right or wrong answer, but there has to be a priority, especially if you can't do all of it. So
yeah.
definitely a good,
Haley and I did that exactly this year.
yeah,
We're like,
yeah.
we're not gonna we're not gonna work on the house this year. We're gonna
right,
take a vacation.
right. So yeah, so it's all, and again, there's not a wrong answer. It's just making sure you have the conversation.
Absolutely.
So well, we're gonna leave it there for the week. Anything else before we sign off, Nick?
Nothing else for me. Thanks for having me,
Yeah.
and I hope listeners enjoyed it.
Yeah. Well, thanks everybody for listening to episode number 236 of the Independent Advisors Podcast. Hope you all have a great rest of the weekend, and we will be back with you next week for episode number 237.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.